For years, cash has been one of the most unpopular segments of the market. However, as the Federal Reserve continues to raise interest rates, it has gained newfound popularity among money managers. Rate hikes have roiled nearly every other asset class, and the risk of a recession is increasing by the day. During times like these, many believe cash is the best asset. So, is it time to call cash is king once again? Let's find out. With inflation at a 40-year high, the Fed has no choice but to keep raising the federal funds rate. This rate increase raises the level of the risk-free reserve in the financial system, limiting the amount of money available for the purchase of riskier assets. Interest rate increases discourage consumer and business spending, particularly on financed big-ticket items like housing and capital equipment. It also has an impact on asset prices, reversing the wealth effect and making banks more cautious in lending decisions. The federal funds rate increase is having an impact on the economy. Almost every asset class imaginable is in decline. Home prices are falling, with a price index of 20 major U.S. cities falling for the first time since March 2012. The West Coast markets have experienced the steepest declines. However, the downturn is widespread. Bidding wars are giving way to lingering listings, and both buyers and sellers report feeling trapped. People looking to buy should benefit from falling prices. Nonetheless, the cost of home ownership is rising in many cases. Mortgage rates have reached their highest point since 2008. Furthermore, research indicates that the likelihood of a recession in the coming year is uncomfortably high. So, who wants to be burdened with mortgage payments if the economy tanks? Stocks provide little comfort as well. Several times, the S&P 500 has fallen to its lowest level since November 2020. The Nasdaq 100 is down about 30% this year, wiping out trillions of dollars in market value. There are numerous causes for the downturn. Many business models' post-pandemic value is being reassessed by investors. Rise of interest rates reduce the value of a company's future earnings. Meanwhile, rising costs are being driven up by inflation, and a stronger dollar is weighing on profits. So, where do we go from here? Our current economic situation is quite uncertain. What is certain is that we are living in economically unprecedented times, and that more difficult times may lie ahead. In turbulent times, people frequently turn to cash as a safe haven. Having cash on hand, especially during a crisis, increases the flexibility of any wallet. But when is cash king in a recession, and when is it not? Before moving forward, if you're liking this video so far, please consider subscribing to the channel. As a consumer and investor, cash appears to be a safe bet. And, on the surface, that's correct. Keeping cash means your account's value won't suddenly drop. However, relying too heavily on cash can jeopardize your ability to meet long-term objectives. The threat of job loss, or unaffordable bills, is one of the most serious threats to individuals during a recession. With a solid cash account behind you, you can navigate uncertainty with greater confidence, knowing you're financially prepared. On the other hand, one significant disadvantage of keeping cash is the ease with which you can spend it. When a recession hits, and money is tight, it's tempting to dip into that cash reserve for some relief. A night out here, a new device there. Those one-time purchases add up quickly. We are living in extraordinary economic times. While recessions frequently result in lower inflation, or even deflation, our economy is still dealing with 7% inflation as a result of ongoing supply chain issues. Because inflation remains at all-time highs, the Federal Reserve is responding by raising interest rates. With higher debt interest rates come higher rates on savings and money market accounts. But we're still dealing with high inflation, which eats up cash. Even if you get 2%, 3%, or 4% back on your savings, you're still losing 7% of your purchasing power to inflation. Holding cash during a recession may simply mean losing purchasing power this time. The more cash you have on hand, the more liquidity you have to seize great opportunities as they arise. When a recession hits, the value of everything, from stocks to bonds to commodities, can plummet. Keeping cash on hand ensures that you are available to respond when these opportunities arise. Waiting for such opportunities, on the other hand, is easier said than done. It is impossible to recognize a good opportunity until it has passed. With cash on hand, it's possible that you'll act too soon, too late, or even not at all, leaving you with a portfolio full of cash and no significant gains to show for it. Because cash is not a stock, it can be useful during a recession. While the stock market often picks up steam during the recovery phase, stocks may fall to new record lows or stagnate during the recession. Having cash on hand eliminates the need to sell at a loss to cover emergency expenses. The stock market frequently falls into bear territory or lower during a recession. This means that investing or cashing out at the wrong time costs you money. However, risk is required to generate returns. Some of the riskiest investments have the potential to generate the highest returns. Taking a conservative approach and keeping too much cash on hand misses out on this volatility. When you hear about economic or stock volatility or growth, it may be too late to get a piece of the pie. Whatever your thoughts are on the benefits and drawbacks of having too much cash, it is true that cash serves as a physical cushion. If you have some cash on hand, you can ride out a drop in your investment portfolio without feeling compelled to sell at an inopportune time. Cash gives investors more options. Imagine having cash on hand during the 2008 housing crisis, or during the market crash caused by the pandemic in 2020. Any purchase made around that time would have returned hundreds of %. The trade-off for holding cash, according to Michael Kitzers, Director of Planning Research and partner at Pinnacle, is that you lose a small amount to inflation in exchange for the possibility of a larger future return. Ultimately, a healthy dose of cash can help to stabilize a current portfolio, while also benefiting the investor in the future. If you enjoyed this video, please subscribe to the channel for more content. Like this video, and leave a comment if you're holding cash for the upcoming markets. Thank you for watching.